So, all right. So we're actually coming from a period of time where we've had deflation for at least 10 years or more. Just we've been in a deflationary environment, and all of a sudden, in the past year or so, we've had this inflation. So we're getting our first real taste for me as an investor, to what it's like for a rising rate environment. Let me see. I'm going to start researching that fixed income and yields, and find out some more about that, because I need to start moving some money over to that part of the world. But one way to invest in fixed income is to ladder your investments. That means we don't know if 6% is going to be the highest the Fed will raise rates, and if we get 8% or 10% later this year, we're going to miss out on a couple of percent. So you have to ladder your bond purchases so that you have 6% that goes out 3 years, and maybe 5% that goes out 5 years, and then these are expiring or maturing in 5 years, so that whenever 5 years comes around, you might have 10% yielding bonds. So that's called laddering. I haven't done any of that yet, but I'm going to start looking into that. All right. So we had a situation. I pulled up a couple things. Let me see. We had a situation Wednesday, and we have a situation Wednesday and Thursday of this week, where we had. We're going to put it in the moving average, 200 day moving average. We'll make that purple. Okay, you can see that we had, back a little bit. Okay, we had something called an outside reversal on Thursday. That is, the stocks open down and they trade up. And if we look at the S&P, and that was at a peak. If we look at the S&P, the 200-day moving average, that's this one right here, the purple one. We're finally at a point where it's starting to trend higher, and we're bouncing off of that 200-day moving average recently. And that outside reversal where we gapped down and then we closed up. That's an indication that a lot of the stocks in the stock market are going to be trading above their 200-day moving average, and that's a sign of momentum. And you can see that we have this higher highs, higher lows pattern starting. And as of yesterday, we were super oversold. And that's why I said, right here, I said, well, we're basically at, let's look at that chart. Okay. So if we look this really close, okay, you can see that we were maximum oversold, and we were at the bottom of this channel. And we have fearfulness in the market starting to creep back into the market. So whenever the stock market goes down, you have people afraid, and when it goes up, people are greedy. That's just the way it works. So we don't have any earnings reports. If we look at our meeting notes, let's look at our calendar. We don't have any good earnings reports until a couple months from now, so until June-ish. So we have to wait for that. Right now, all the earnings reports are almost all done. We're at the beginning of March now, and we have 2 inflation reports coming out the 14th and 15th, and that could move the market one way or another. But right now, we're super oversold, and we're at a point where we're nearing an end of the interest rate hikes. So we have. I'm going to talk about a talk by David Einhorn. Wait, let me get his name right. We're going to talk about an opposite side of, this guy is kind of bearish on the stock market, and he thinks inflation is going to go higher, and David Einhorn. Look at what he said. Okay, there was a David Einhorn from, he has a Greenlight Capital, I think it's a hedge fund. He was on CNBC Halftime Report. He said last year, he said, the correct posture is to be bearish on stocks and bullish on inflation. So basically, as the interest rates go up, there's a competition for the investing dollars, and some goes into fixed income and some leaves the market. And that's his theory. His theory is that inflation is going to be higher than expected, and he says the rates will go higher than expected. So he has a very interesting way of investing for his hedge fund. It's a lot different than what I'm comfortable with. He basically has a 51% long and a 49% short position. So we're going to go over some of what he said later on, and try to match it to what we're seeing in the stock market. But it's always good to have a couple points of views and see what other people are doing when they're investing, because maybe the theories that I have aren't right. Maybe there's other ways of looking at the market. All right, so we have what else do we have going on here? Okay, so we have 2-year and 10-year up 4% this week. That's primarily why the stock market's been jittery. We've been saying for a year now almost, the interest rates go up, the stock market goes down. Let's look at the 2-year and 10-year today. They're down. So that kind of follows that formula still. Interest rates, the 10-year, 2-year go down, stock market goes up. Pretty simple. All right, so we have the Fed is still in an aggressive stance. They're going to raise more rates, raise more in the interest rates, at least 1 or 2 more times. So it's going to be basically mark time for the market until the Fed's done tightening. Let me see. The interesting thing about the stock market now is we're basically at a PE of 18. The average for 10 years has been 17. And so there's not a whole lot of reason for the stock market to be going up, because the earnings aren't going up. They're basically going to be, the earnings estimates are coming down over time and for this year. So that's basically an indication we're going to be sideways basically the rest of the year. But for me, I know this year is just like, it's a year that doesn't have a whole lot of upside to it, but I'm invested for the long term. So I know that this year is going to be flat or so, and probably the stock market next year or the year after will start resuming all of its growth rates. Okay, let's see what else is happening here. Let's see. Okay, we see the crude oil is up. It's basically up percent since last week. There's nothing really to say about that. Inflation, it's getting a little bit worse this month. The U.S. dollar index is unchanged, so we can't really make a whole lot of that from that. It's still in a downtrend, but it's still hasn't changed since last week. Let's look at some of the sectors that are doing good and bad. Okay. The one's doing the best. Oil, metal, consumer discretionary. Okay, these are home builders. Okay, so this is all kind of hinting that interest rates are like peaking, and that's kind of we have the treasuries going down, maybe the interest rate. Home builders, they go up because the interest rates are going down. That makes sense for that. Oil and gas. Let's look at the the price of oil today. Oil is up 1.3%, so we expect all oil and energy-related things to be up. You see this, what things are doing the work. Consumer staples. Okay, so seems like on a regular basis, we are switching between what worked good last year and what works and what didn't work good last year, and we're fighting between the two. So consumer staples were some of the worst and best performers last year, and now it's the worst performer of the day. And let me see, technology was the worst performer last year, and it's one of the best today. So it's like flipping on a regular basis, but it's this in favor, out of favor on a regular basis every day this year. It's kind of the market's been half and half. Half what worked last year, half the days this year it's been what worked good last year, and what didn't work good last year is up and down. So right now it's just it's the stocks that are recovering that went down last year. Okay, so let's look at some more things. Let's look at some of the stocks that are going up and down today. This is a good example of stocks that did really poorly last year and are recovering. So we see Meta was down 70%, and it's still in the process of recovering. We know Align, they do plastic braces, and they were down extreme amount last year, and now they're bouncing back. Let's see what the ones that are doing the worst. Costco had an earnings report, and that's why they're down some. And Union Pacific. Okay, Union Pacific, they had this toxic waste spill in Ohio, and sometimes whenever stocks go, and this example, they have a monopoly for the duopoly. There's only 3 different train stations that work in America, and they have a monopoly in their part of the world. And if this stock goes down a lot from this one news story where they might have some kind of liability from toxic train derailment, that's a very good stock to look at, because they'll recover, and they still have a monopoly. They'll pay whatever it costs to clean that up and to resolve this situation. But if it drops down to 100 or something like that, I'm going to start dollar costing into it, because I know it's a monopoly, and I know they don't make any new railroads. All right, so other stocks that are going down. These are Lumen Technologies. They make electronic vehicles, and they're unprofitable. So that's, I guess they're not producing as many. They don't have a good demand for their products. And what other things are in common here? Semiconductors are down today. Qualcomm, Lam Research, and Hormel Foods. This is a food staple. They make Spam and a lot of other different types of foods. So this is a very conservative company that probably did really good last year, and it's out of favor today, because that went up and did good last year are not doing good today. Let's look at Hormel, because this is one of Ingrid Hendershot's favorite stocks. Let's look at that just for fun. HRL. Okay, so this is an example of a conservative stock. They make food, and there's a constant demand for food. This is interesting. Why there's some big... Let's go out. Year to date, 1 year, maximum. Okay, we're at like a 52-week low here with this thing. Is it 52 weeks? No. Let's do 1 year chart for this. Okay, it's a 52-week low today. I wonder why. $40 a share. This is the same. Okay, so it has a lot of support at this $40 level. In last year, in September, it was at that same level. And let's look at the pandemic lows. Okay, so that was at 42. $40 a share. So it has a lot of support here. So there's a very good chance that, it's going to probably hold here if it had all the support going way back. How many years? Pandemic low is 42. This is a very conservative stock that probably pays a dividend. We're going to look at that just for fun. Trying to get the Hormel. It's taking forever.
So I know you look at the CFRA.
Oh, yeah.
They just downgraded Hormel.
Oh, really?
Yeah.
And how? And okay, that means a lot because I HRL. Let's look at that. Because I value CFRA's fair value model. That's. Let's look at their statistics. See if they're yielding 2.5%. So it's a dividend-paying stock, and so in an inflationary environment, they're going to raise their prices and probably have a consistent demand. Why did I go back to here? I'm trying to go. Okay. Oh, it's hiding this from me. They never used to hide that from me. All right. What can we see? We don't have any numbers. These are all zeros. Okay. This was a bad one to look at. Everything is not available for some reason. Okay. We can't really research that now. This is an example of a stock we know that Ingrid Hendershot likes and has held in her portfolio for 15 years, and it's down to a multi-year low, and it has support. So next week I'll research this when we have some good numbers here. But it's an example of something that pays a dividend, it's conservative, and it's probably down based on a downgrade, but it's down 2.5%, down to, might have some value to it. We'll look at that later on. All right. So let's go back to our market movers. Okay, so we see Hormel's down, and let's look at the NASDAQ stocks going up and down. These are all stocks that have super high PE ratios that have been thrown out last year, and now they're in the process of still recovering. So most of them are down 20 to 70% or more, and the ones doing the worst are the ones that are more conservative. So these are ones with lower PE ratios that that didn't do as bad last year. All right, so we have another one of those bifurcated markets, if you want to call it that. All right, so let's look at. Okay, so the important thing we're going to concentrate on now is the S&P has been going down for a year now. Lower highs, lower lows. We noted whenever it kind of broke out of here, there's a good chance, that if we have momentum, might break us out into this higher highs, higher lows. And you can see how all these are moving averages. This purple line, this green line, this is a 50-day moving average, 100-day, 200-day. And they're all kind of converging right here. And the stock market is staying above that moving average. And as soon as they start turning positive, these moving averages, and the majority of stocks in the S&P start going above their moving averages, that's something called momentum. It's great for momentum. And we had an outside reversal, and that's a good indicator that we have support, at that 200-day moving average. So on Thursday, it was down a lot, and then it closed up, and it went down to that moving average, and it closed up. So that's a good indication that we have support on this bottom end of this channel, and we could be starting in this higher highs, higher lows. All right, and the other things to keep in mind when we're looking at this, let's look at the S&P again. Let's go back a couple years and see what levels of support we have. So this level here, this was 240, 228. That was the pandemic low. And right now we're double that. We're at 402. So basically, if we end up going down from here, we have pretty strong support, right here at this 394 in the SPY. We have this level here, which is 376, and we have 360. So if we go down, we'll probably have these levels of support that's held right here. That's the same level here. And if we blow past this 386, then the next level of support is here, which is 326. Then we have 228, which is the pandemic low. But right now, tentatively, we're in this uptrend, which is pretty good for stocks. So let's go back to our talking points in our meeting. All right, so let's look at review of Dan Niles and Leon Cooperman's. Dan Niles thinks we have a fair value of 3,000. If we look at our chart here, 3,000, it takes us down to like right here. Wow, that's a long ways down. It's 20% below where we're at now. And he says a 50% chance we're going to be sideways the whole rest of the year. All right, so let's keep that in mind. But the average S&P, the S&P has traded for has been 17 for the past 10 years. So if we go 10 years, okay, so 17, and we're at 18 right now. So that's another indication that if we trade at the average all year long, we're going to be flat for the rest of the year. So that's kind of why we have these pretty unknown for the whole year. We don't know what's going to go on for the whole year, but it seems like right now we have a little bit of momentum. And I listed March as green because March is traditionally one of the best months of the year. It's usually up 1%. And we're nearing the end of a rate cycle, and we have end of quarter window dressing coming. So we have a couple of good things to look forward to. And the 17th, we have triple witching. Remember that. I have these little indications down here at the bottom. Triple witching dates. That's the simultaneous expiration of options, and that is a very volatile day. So we have to keep these things in mind. And then the 31st is, okay, this is the end of quarter window dressing. So we know what all those are. All right, let's go back to some talking points here. Okay, fear greed index. As the stock market has been going down, the confidence of people have been going down. And it's becoming neutral now. It used to be greed last week. So as the stock market goes down, people get more fearful, and as people get more fearful, they're more likely to sell out of their positions, and then you get to a point where there's a crescendo, like on Thursday, people will sell out, and then you have the buyers come in, and that's the stock market participants that have the stronger hands. So right now we're neutral in our fear and greed, and it's almost a 1-to-1 correlation to the S&P whether it's going down or up. All right, so okay, VIX is going down too. So probably today it's down more. So right now it's starting to have a lower fearfulness. The more it goes down, the VIX, the higher the conviction of the people not to buy protection and not to be afraid. So, okay, we know that that's inverse correlation. So I was talking earlier about this interview with David Einhorn from Greenlight Capital. He his way of investing that I'm comfortable with. He's like a bottoms up investor. He likes to see intrinsic values of companies. He's a value investor. I like to think I'm a value investor. I try to buy things on sale, but he looks at things a little bit differently. And last year he was up 36%, 33.3% net of fees. That's versus 20%, minus 20% for the S&P. So it was like his first year. He's been underperforming the stock market for 10 years. And people started losing faith in him, and all of a sudden he has this great year. And it's because value investing last year started to come back into vogue. So we're going to look at some of his, what I mentioned last week, that the 13 Fs are coming out for mutual funds, etc. They have to report what they're holding, these mutual funds, hedge funds. So we get to see what these really smart investors are doing. And I'm trying to get my mind around the way he values stocks. And I tried to make sense of his top holdings. And during this interview at CNBC has a halftime report. And you can download these podcasts for free at iTunes Store and other podcast apps. And so on Wednesday, they interviewed him at the beginning of the show, and he was talking about how we have a strong economy, strong employment, and yet we still have high inflation. So the way he's investing right now is he's shorting unprofitable tech companies, and he has 49% short position and 59% long position. In his long, we're going to go over some of his long stocks in his portfolio now after this. But he favors stocks with strong demand in inflationary times, such as healthcare and energy. And let me see. So we're going to highlight two of his recent stocks that he bought new positions in: Tenet Healthcare and Tech Resources. Tenet Healthcare, he's very bearish on the stock market now. He's trying to find his positions that are safe and stocks that are trading inexpensively. So he thinks that both of these companies are buying back their shares, and they're trading at a very low multiple. So they're trading under a PE of 10, and he thinks that people will still spend for healthcare in good times and bad. And I have a CFRA report, that says the opposite. They said, well, in a recession, people will skip healthcare because they don't have the money. So there's two sides to every investment. So Tech Resources, he said his thesis for this company is they have a really big cash flow. They're buying back their stock, and in a couple of years, basically they're going to buy back all their stock, and the only thing left is all their deposits. It's going to be it's a very interesting way to look at things. I didn't really see it that way when I looked at the numbers, but it might take a while for me to really figure out what he was saying. But basically, if they buy back all their stock and they have enough cash flow, basically more than the companies were, then that makes it a good investment. So we're going to look at you can actually look up every hedge fund's top positions, what they sold out of, and what they new buys. And so I said, well, let's look at some of the new buys. And this Tenet Healthcare, it's probably one of its largest holdings, and a lower holding is Tech Resources. They're kind of unlike SI because I don't understand those industries, but we're going to look at it just to get exercise. So other comments about this. Last year, he had a really big position in Twitter. It's not because he valued Twitter at earning a certain amount. He thought that the deal had to go through. The purchase by Elon Musk had to go through. So he basically was an arbitrage play, and that turned out really good for him. That's kind of the thing that hedge funds do. They figure out arbitrage situations, and that the calculations are that you would probably be forced to make the deal. So other things, hold on, where did it go? Okay. What are things that come out? Okay. So let's look at the Tech Resources. They one of his long-term themes in his investments is we're switching to EV cars, and there's going to be a lot of demand for resources for those cars, and it's really hard to open copper mining companies because of it's really hard. You have to get permits, and you have to spend several years before you can actually get started. And he says they're currently making copper, zincs, steel making coal, and a couple other different types of metals. And that was one catalyst for the company going up. They have a lot of coal reserves. And so I started looking at their numbers. That doesn't look too exciting to me. It looks like it's going down. I would expect at least to be flat, but he's basically excited about, so we couldn't get a real, using my formulas, I like to buy things that are going up in a straight line. But we're looking at the numbers here from Yahoo Finance, and we can see the PE is 9. The profit margin is good, and the return on equity is good. What David Einhorn was interested in was this cash flow. His free cash flow is $900 million a year. And over time, if you have this much cash, eventually that's going to be more than the market cap. And then you can take the company private if you buy back all the shares. So we'll revisit this, in the future, or maybe when I understand it better. During the interview, he was saying that the market cap is currently lower than 21 billion, but he said over time this company will basically just go private because they'll buy back all their stock, and they'll have 30 years of coal resources at the end of all of that. They could sell that off. So it's a different way that I am used to investing in, but let's keep an eye on this. It's a smaller stock, but it does involve something that I'm not invested in a whole lot, like oil and coal. So I looked at the CFRA. They didn't cover this, so we rely on Morningstar. Morningstar says they're worth half of what they're trading at, so it's 40% overvalued. They said they have no moat, and higher near-term costs and capital expenditures due to inflation. And they're going to spin off a metallurgical coal business pretty soon. So that could be a catalyst to unlock value for the company. I don't understand what David Einhorn saw in this, but he was very excited about it. He thought in a couple of years they would basically go private, and as soon as he started talking on the TV, it went up 10%, 5 to 10%. So I'm not sure what to make of this. We'll revisit it once I understand it better. The other stock that he highlighted in his talk was Tenet Healthcare. This is a company that's um, they do basically they run hospitals and stuff like that. So it's a very conservative business, and this follows our theme that's worked the last year, and it's very conservative. That people, there's a continuous demand for healthcare in good times and bad. People aren't going to, if they're sick, they're going to go to the hospital. It doesn't, regardless of cost. So I looked at their numbers here. The growth. So you can see that from 2022 to 23, they're down in their earnings estimates, and that's probably why he started his interest in this. He thought it was a temporary downturn in the company. He started buying it last year. So I looked at these numbers, the annual earnings estimates. They said 15 to 10%, around 15% earnings growth for the next 2 years, and then it'll be flat the year after that. I don't know why, but so let's say if they're growing at 15% and their PE is 10, so they're 35% undervalued. But Bank of America doesn't have as nice information on them. They said they're only growing at 4%. So if they're only growing at 4%, then they're twice the value they should be. I like whenever everything lines up, and you have 14% here, you have 14% here, and you have some confirmation that you have a good multiple companies that agree with the growth rate of the company over time. So it's a little bit sketchy. Let's look at the next thing. So they have a market cap of $6 billion. That's a really small company, relatively speaking. Their PE is 10. So David Einhorn likes stocks with a very low PE ratio. That worked well last year. Last year, he was up 36% because most of his stocks that he had were under, really low PE ratios, and they were value stocks. Profit margin is only 2%, and the return on equity is 22%. But one thing that's consistent with most of his stocks is they're mostly generating a high free cash flow. So that's $238 million a year. So that's, I think what he likes is high free cash flow compared to market cap. So that's the two things that are in common with his stocks that he was talking about in that show. Okay, so but when I looked at Morningstar, Morningstar said that they're half the price they should be, and they highlighted reasons why. They said they have a very high uncertainty rating. So it's that's interesting. I thought there'd be high demand, a consistent demand for healthcare, but they're benefiting from recent share repurchases. So they think it's half price. And I'll look at the CFRA. They said it's about fairly valued. They said it's overvalued by 12 or 20%. The reason why I wouldn't necessarily be interested in this is you don't have a consistent history of making money. I want this to go in a straight line if I'm considering something, maybe one or two bad years, but this is all over the place. It's -1, this free cash flow, -3, and then you have the P ratio. It used to be, this is interesting, it used to be 30. They used to sell at a premium for several years, and every year it's selling for less and less of a premium, and like right now it's down to P of 10, which is pretty much the low of the last 10 years. And the revenue hasn't gone anywhere. It's basically been the same every year for the last 10 years. So it's not really a growth company. I would agree more. It's more of a 0 to 4% growing company. So here's some comments for CFRA. They said, we remain neutral on healthcare facilities due to inflationary headwinds. They think the cost of staffing and labor costs, and there's all these near-term costs that could hurt the profits of the hospitals. And on top of all that, there are people that might skip out of surgeries or elective surgeries due to the recession. So it seems like a really sketchy thing. We're going to revisit this when it's double the price it is now and say, hey, that guy's pretty smart. We missed it. But I can't really see the value in this right now. Sometimes you just have to go through this process to really make sure it makes sense to you, and make sure you have something that you have conviction in. And I don't have a whole lot of conviction in this one. Okay, so the other thing I wanted to bring up today was the 13F filings. Every 3 months, the mutual funds and large financial companies have to show what their holdings are. And so I did a couple of the ones we're following for the last couple of years and see what changes there are. And we see that one thing in common, we looked at Fidelity Magellan, T. Rowe Price Blue Chip, Fidelity Contra Fund, Fund of America. I try to get different companies so we don't have the same company with multiple mutual funds. We did have Fidelity twice here, but I think these are important because these are two of the biggest ones. So the changes they made, they increased the United Healthcare and NVIDIA. We've seen NVIDIA on multiple mutual funds as a top holding that wasn't there last year. So that's whenever we see something like that, and the stock is down, we say, well, maybe there's a reason, that could be a long-term buy and hold stock for a part of your portfolio. And ones that have, I mark these as red. Red is the ones that these companies sold out of, and the green is the one they bought more of. And so I noticed that this Fund of America, they basically have the same holdings in different amounts. Sometimes the percent changes because of the price of the stock. They might hold the stock, but Facebook, for instance, is down substantially since 2 years ago, or last year. So even though they haven't sold any, it's just down a little bit in the percent. So you can't count that against what we're doing here. Just comparing. So we have this Broadcom. They do I think modems, the iPhone. That's probably a good portion of the business. Let me see. That's another one. Yeah. Oh, let me see what else. So we see Berkshire Hathaway. This is pretty big. Contra Fund. They used to have Facebook as their top holding, and Meta actually, that just went down with the price. They actually bought more Meta because even though the price of Meta is down, when the price goes down, you get a lesser proportion of that in your portfolio, but you have to buy a little bit more for it to keep that percentage. But Berkshire Hathaway is the first time we've seen this in Contra Fund ever. So the interesting thing about Berkshire Hathaway is they've been buying back their stock. They bought $66 billion back of their stock. That's more than they invested in Apple, and that's a good indication they believe in their company is near the intrinsic value, which is the what is it? Book value.
Yeah.
So
I know that they had set up that they would buy when their book value is, at a certain point. Are they buying based on that automatic buying, policy they have?
I'm not sure. I think they bought a lot of their stock back, and I think they've had a hard time. Berkshire Hathaway has, in their annual meetings, they basically said there's nothing out there that really interests them. So buying back their stock is the best thing they could do with the shareholders' money, which is interesting because they have, close to 180 billion in cash right now. They could buy anything, but they think things are overpriced. So but they bought $66 billion back there in stock. I guess we can start. It's Berkshire Hathaway is one of the hardest stocks to understand because they don't have these PE ratios that we're comfortable with. They don't have the same easy business model. No, they don't have the same. They don't have a simple business model like perhaps Apple does. Apple has, let's say, 40% of their income is, or their profits are coming from the App Store, services, and 40% is from iPhones. But Berkshire Hathaway, they have 100 businesses. They have a railroad, they have insurance businesses, and we got to keep track of every one of those things. And they have investments in different stocks. It's really hard to value. So you have to basically trust, Warren Buffett, the best investor of all time, that he's making, the best resources, the best use of the money that's given to him as all these companies that he owns generate lots of cash, and they got to do something with it. So that's kind of what you got to do with Berkshire Hathaway. But this is the first time we've seen Berkshire Hathaway in this contra fund. So let me see what else. They didn't have Apple before in their top 10. So that's very interesting. And NVIDIA. So NVIDIA came up 3 times just in this little exercise. So that's good indication whenever stocks get down to there. When stocks that are supposedly quality stocks we're following, they get down to an intrinsic low level, you have to start. If you're interested in long-term investing and buying and holding stocks for 10 years or more, and if any of these stocks that are in these top 10 holdings go down and substantially, you might want to start looking at them. So let me see, what else? Is there any other comments on this? All right.
Nope.
Okay. We see that T. Rowe Price had positions in Chinese companies. That's been one of the best performers this year. I mean, they were sold off super heavily last year. We were all speculating why, and it was the Chinese government was kind of making these capricious rules. We couldn't understand why would they try to make the companies in their country go down, and they're finding them, and it was so hard to value them. So they sold out of both of those, and they got into more American-like companies, which is interesting. They got out of MasterCard and PayPal. And that's T. Rowe Price blue chip. So it's always good to look at what these mutual funds are going in and out of. It'll take like a month to go through every one just to analyze why they did things, and but whenever companies, these mutual fund companies, it's in their best interest to buy and hold the stock and not to sell, because whenever these mutual fund companies sell, they're forced to sell because there's buys and sells into the mutual fund every day. But when they sell big positions in stocks, their shareholders have to realize those gains at the end of the year. So the turnover is a very important percentage for each of these. So that's why it's good if you're interested in a long-term growth part of your portfolio, it's good to look at these to get more confidence that, hey, if these companies have an unlimited resource, they can talk to these presidents and they could understand them better than we can, and they still hold them after 10 years, it's probably a good idea to buy some of those. All right. So let me see. Okay, let's look at the where we are. We know we're neutral in the fear gauge, CNN fear gauge. So neutral is we're kind of returning to normal. So what I did with this week is looking at our map here. We know that we've had a lot of momentum in the past couple months here, and where we have basically this, whenever stocks are at the top of this range, people get super excited and they're greedy. And when we're at the down part of this animal, people are get neutral to fearful. So you just have to switch your gears and not be fearful whenever it's down, and whenever it's at the top of the range, then you start um, not aggressive and fearful. So it's good to think the opposite. And whenever people are capitulation and there's despair, that's the time you want to start looking into getting things. So I think that's it. Well, hold on for a second. I'm going to undo that. Okay, so this is one of the last slides here. This is one of the best months of the year. April next month is going to be the best month of the year. So this is a seasonality thing. As we come out of this rate cycle, one of these months, the Fed's going to say that's it. We're pretty much done. Or August is going to be the last day of Fed tightening, and that's going to be really good for the stock market. But until then, I think we're going sideways or so. But this is traditionally a good part of the year, so keep that in mind. And I think all I had.